Welcome back to the Deep Dive. Today we're tackling weekly options trading. We're using Profiting from Weekly Options by Robert J. Seifert as our guide.
Sounds like a plan.
It really dives into the nitty-gritty of the strategies, but also the mindset you need, to succeed in this fast-paced corner of the market.
Yeah, it's definitely not for the faint of heart.
So we'll unpack those key takeaways, the things that'll make you go, aha, along the way.
It combines market mechanics and that mental discipline, right? Being able to make those smart decisions under pressure. We'll be looking at how weekly options are different from those traditional options and why they might be a good fit for some trading styles, but not others.
Now, the book really kicks off strong. Right off the bat, it emphasizes market psychology.
Absolutely.
It even dives into those historical bubbles like the South Sea Bubble, the Cotton Panic of 1837, even, Bitcoin, to show us just how powerful those emotions can be in driving those market trends.
What's really interesting is how these events, from different centuries even, they all share that common thread. It's always the human element.
Yeah.
Whether it's the 1700s or today, greed and fear, they can really mess up valuations. It leads to those classic boom and bust cycles.
Almost like a cautionary tale, right?
Sure.
You've got Sir Isaac Newton, a genius by anyone's measure. He got swept up in the South Sea Bubble and lost, well, a fortune.
That's a good reminder that we can all fall prey to those psychological biases, especially when there's a chance to, get rich quick.
Yeah, absolutely.
And this book really argues that those same forces are still at play in today's market, especially when you're dealing with stuff like weekly options,
Right.
where those short time frames can really amplify those emotions.
So how do we avoid falling into those psychological traps? What does the book recommend?
Well, it really advocates for a technical approach, focusing on price charts and patterns to understand how the market's behaving right now. It argues that fundamentals are already baked into the price. So instead of trying to predict, like, future news or events, we should focus on what the market is telling us currently.
So it's like reading the market's language rather than trying to write the story ourselves.
Exactly.
I like that.
And that's where understanding how these markets actually work comes in.
Yeah, for sure. Now, the book gives a really comprehensive overview of stocks, futures, index futures, forex, and of course, options themselves. So let's start with the basics. Stocks. What are the key things we need to know?
Okay, so when a company decides to go public, they do what's called an IPO, right?
Right.
They're offering shares of ownership to the public. And the portion that's available for trading, that's called the float.
Okay.
And the price of those shares, it's all determined by supply and demand.
That makes sense.
Yep.
But the book takes it a step further, talking about the aggressiveness of buyers and sellers. What does that mean exactly?
It's not just the number of buyers and sellers, but it's the intensity of their desire to buy or sell. Think of it like an auction. The more bidders there are and the higher they're willing to go, the faster that price is going to climb.
So it's not just about if there are more buyers than sellers, but the conviction behind those trades.
Exactly.
Okay, so that's stocks in a nutshell. Now, what about futures markets?
Oh, futures. Those are interesting.
Yeah, they seem a bit more complex.
They have been around for a long, long time, actually.
Yeah.
They originated with, like, agricultural commodities way back when. Farmers, they wanted to lock in prices for their crops in advance, right? Protecting themselves from price swings.
Right.
So they came up with these contracts to buy or sell a certain amount of, say, corn or wheat at a specific price on a future date.
It's like pre-ordering your harvest at a set price no matter what the market does later on.
Exactly. And eventually, futures markets expanded to include other commodities and even financial instruments like currencies and interest rates.
Okay, that makes sense. Now, the book also talks about index futures, right? Which are based on baskets of stocks like the S&P 500 or the Dow. What's the advantage of trading those instead of individual stocks?
Well, with index futures, you're getting built-in diversification.
Right.
So it reduces your risk, You're not putting all your eggs in one basket.
Right.
Instead of betting on just one company, you're betting on the movement of a whole sector or even the entire market.
So if one company in the index has, some bad news, it's not going to tank your whole position.
Exactly. Plus, it's often easier to analyze the movement of an index compared to keeping track of tons of individual stocks.
Makes sense. Now, the book also touched on Forex. That's the foreign exchange market where currencies are traded, right?
Yep.
That one always seemed a bit intimidating.
Oh, it's massive and it's complex. It operates 24 hours a day, 5 days a week.
Wow.
We're talking trillions of dollars,
Yeah.
changing hands daily, influenced by things like interest rates, economic data, and global events. It's definitely not for beginners.
All right, maybe we'll save diving into the Forex world for another time. Let's focus on options, specifically since that's what this deep dive's all about. The book mentions that options have been around for ages, even dating back to ancient
Oh
Greece.
yeah, the idea has been around for centuries. It's evolved over time, but the core concept is still the same. An option gives you the right, but not the obligation, to buy or sell an asset. At a set price, we call that the strike price.
So it's like you have a reservation at a restaurant, you can choose to go and claim your table, or you can just skip it.
Exactly, a perfect analogy.
But you've paid a little something for that option to decide later.
And there are two main types, calls and puts.
Right.
A call option gives you the right to buy the underlying asset. A put option, you get the right to sell.
So if you think the price is going to go up, you'd buy a call. And if you think it's going to go down, you'd buy a put.
You got it. But the key here is you only exercise that right if it's profitable. If the price moves against you, you just let the option expire. You lose only that premium you paid.
So options are a way to kind of like limit your risk while still being able to profit from those potential price moves?
Precisely. They can also be used to generate income or to hedge existing positions, making them super versatile tools.
Now, the book we're looking at focuses on weekly options. What makes them different?
The big difference is the expiration date. Weekly options, they expire every Friday. Much shorter lifespan than those traditional options, which might expire months or even years down the line.
So they're for traders looking to like capitalize on those short-term swings in the market.
Exactly. They offer potential for fast profits, but you also have that accelerated time decay. The option's value erodes quicker as it gets closer to that expiration.
So timing is critical with weekly options. Less room for error.
Absolutely.
Mm.
And that leads us to another important thing, liquidity.
Right.
The book emphasizes how important it is, the ease with which you can buy or sell an option.
So it's not just about finding a good price. You need to be able to actually get in and out of the trade easily.
Exactly. And here's the thing, liquidity isn't always tied directly to trading volume or open interest.
Oh, really?
Right.
I would thought more activity would mean more liquidity.
It's not that simple. The bid-ask spread, that's the difference between the buy and sell prices, that can really impact liquidity.
Okay.
A wide spread can eat into your profits, even if the option itself seems attractive.
It's like trying to buy a souvenir at a tourist trap. You might find something you like, but those inflated prices make it a bad deal.
Exactly. So when you're choosing weekly options, look for those with tight spreads and low commissions so you can trade efficiently.
Gotcha. Now, I gotta admit, the option model itself, all those different strike prices and premiums, it can be a bit much.
It can be overwhelming.
Is there a way to visualize it that makes it easier to understand?
Well, the book uses a really cool analogy, a balloon.
Okay.
Imagine the option chain, the list of all the options for a particular stock. Picture it as this parabolic curve.
All right, I can see that.
The at the money, the ATM strike price, that's at the peak. And the premium, that's also called vega. It's like the air inside that balloon.
Okay.
The ATM strike has the most air because it has the highest uncertainty.
Yeah.
Right? The price could swing either way.
So as you move away from the ATM, the uncertainty decreases, and so does the premium, like air leaking out of the balloon.
Exactly. And eventually those auctions, they reach parity. Their intrinsic value matches the price. No air left in the balloon.
So those are the teenies, right? With hardly any value.
That's right. And this balloon idea helps us see how options are priced and how they behave as that underlying asset price moves.
Okay, that's a helpful way to think about it. Now, I'm ready to talk strategies. The book goes over a few, like credit spreads, debit spreads, risk reversals, back spreads, even just buying options outright. Where should we start?
Let's begin with credit spreads. Those are a popular choice for weekly options, especially in certain market conditions.
All right, let's dive in. What are those key characteristics of a credit spread?
So with a credit spread, you're selling options to collect premium. You're essentially betting that the price of the underlying asset won't move much.
So you profit if the option expires worthless.
Well, that's one way to win.
Oh,
There are actually 3 ways a credit spread can be profitable.
okay.
First, The price moves in your favor, staying within that range you defined.
So you were right about the price not moving much.
Exactly. Second, the price stays pretty flat, so you collect the premium without the option being exercised.
You win by being patient.
Right. And third, the price moves against you, but not enough.
So you know exactly how much you could lose, which can be helpful when managing risk.
Now, let's compare that to a debit spread, where you're buying options, not selling them.
So you're paying a premium and not collecting one.
Correct. And with debit spreads, you only profit if the price moves significantly in your favor. It's a more directional trade.
So if you're bullish on a stock, you might buy a call debit spread, betting it'll go up past a certain level.
Exactly. But keep in mind, if the price doesn't move enough, you lose that entire premium.
Okay, so debit spreads are a bit more aggressive.
You could say that. They need a bigger price move to be profitable. Now let's switch gears and talk about risk reversals. They're also called synthetic longs or shorts. These strategies are designed to mimic owning or shorting the stock, but with limited risk.
So you get the benefits of owning stock, but without that full downside potential.
Exactly. For example, a synthetic long that replicates the gains of owning a stock, but with a defined maximum loss.
How do you create a synthetic long using options?
Well, you sell a put option, and at the same time you buy a call option with the same strike price and expiration date.
So if the price goes up, the call option will increase in value. That offsets the potential loss from the put option.
Precisely. And if the price goes down, your maximum loss is limited to the premium you paid for the call minus the premium you received for selling the put.
That's pretty clever. Now, the book also mentioned back spreads, specifically one called a 1x2 for even. What's that all about?
A 1x2 back spread, that's a bit more advanced. It uses options to try to get really high returns with, limited risk.
Okay.
You buy two options and sell one, aiming to profit from increasing volatility.
It gave an example using the Apple option chain. Can you walk me through how that would work?
Sure. Let's say you're bullish on Apple and you want to use a 1x2 back spread.
Okay.
You'd buy two call options at a lower strike price and sell one call option at a higher strike price.
So the spread is wider than a regular credit spread.
Right. And since you're buying two and selling one, you're long Vega, which means you profit if the implied volatility of Apple goes up.
The for even part means you start the trade for a really small debit, maybe even a small credit, right?
Exactly. So your upfront cost is low, but your potential reward is unlimited.
But what about the risk?
Your max loss is limited to the difference between the strike prices minus any net premium you received or paid.
So it's still defined risk, but with the potential for like really big gains if volatility jumps up.
Exactly.
Okay.
But the book does caution that back spreads can be risky in volatile markets. Those premiums can swing wildly.
So it's not a strategy to use without thinking. You got to understand those market conditions and have an exit plan.
Absolutely. Now, finally, let's touch on buying options outright. This is probably the simplest option strategy,
Right.
but also the riskiest.
This is where you just buy a call if you think the price will go up, or a put if you think it'll go down.
You got it. Your maximum loss is only the premium you paid, but the potential reward. Theoretically unlimited.
High risk, high reward.
Precisely. The challenge is those options could expire worthless, and you're out your entire investment.
So the strategy needs careful planning and timing.
The book says buying options outright can be good when volatility is high, and you're expecting a big price move.
Okay.
But you have to manage your position size carefully and have a clear exit strategy.
To like minimize those potential losses.
Absolutely. It's all about balancing risk and reward, which is a key idea we'll keep coming back to as we go deeper into weekly options trading.
This has been a fantastic overview. I'm starting to feel a lot more confident about navigating this whole world of weekly options. What's next?
Now that we've laid the foundation, let's move on to some real-world trading scenarios. We'll use the Apple option chain as a case study, and we'll look at how to spot those different market phases and use the right strategies for each.
That sounds great. I'm ready to put this knowledge into practice.
All right, let's do it.
Okay, so we've got like the mechanics of options down. We've got a few strategies in our back pocket. But how do we actually use all this stuff, in the real world?
Well, that's where the rubber meets the road, right?
Yeah.
The book gives us this clear three-step process for every trade. Observe the portfolio, check the market phase, figure out your equity needs.
It's like our pre-flight checklist.
Exactly. First up, observe those stocks we picked. In this case, Apple. We're looking at its price action, how volatile it's been, and how it's moving compared to the rest of the market.
We're like detectives looking for those clues, trying to predict what'll happen next.
Precisely. Is it bouncing around in a range? Trending up? Down?
This observation, this tells us what market phase Apple's in. And that leads us to step 2.
Let's say, for example, Apple's been stuck between like $587 and $597 for a couple weeks, like we talked about earlier.
Okay, that sounds like a congestion phase. The market's kind of in a tug-of-war. Neither the bulls nor the bears are winning.
And for that, the book recommends credit spreads, right? You got it. We're betting Apple's going to stay within that range, letting time decay do its thing. If it's near the top of the range, we sell bull put spread. And if it's near the bottom, we go for a bear call spread.
You're basically making a box with our spread, hoping Apple hangs out there until expiration.
Exactly. But remember what the book said. Use multiple time frames.
Huh.
Don't just look at the daily chart.
Right.
Look at shorter ones, too, like the hourly or even 15-minute charts.
So we're not just relying on one piece of the puzzle. We're checking everything to make sure, we're not jumping in too soon.
Exactly. Multiple time frames, they help us fine-tune those entry and exit points. Gives us an edge.
Now, what happens if Apple breaks out of that range, just starts trending upward, really moving?
That shows us the mood's shifting.
Yeah.
The bulls are taking control, momentum's building.
And in that case, we'd switch to risk reversals or back spreads.
Exactly. These let us ride that wave up, but with, defined risk. Unlike just buying calls, which can get pricey when things move fast. Let's say Apple blasts past that $597 resistance level, and now it's around, say, $605.
Gotcha.
Clear bullish trend there. A risk reversal would mean selling a put spread below the current price, maybe using the $600 and $595 strikes, and then buying a call spread above, maybe using the $610 and $650 strikes.
So we're getting premium from the put spread, and we're participating in the upside with the call spread, all while limiting our potential losses.
Exactly. A balanced way to, harness the power of a trend.
And what about that 1x2 back spread we talked about? How would that work in a trending market?
Remember, with the back spread, we're buying 2 options and selling 1. It's a leverage bet.
So if Apple keeps climbing, our profits multiply.
Precisely. But we're also taking on more risk, especially if the market gets choppy or reverses direction.
Because we're long Vega, and volatility can work against us then.
Exactly. So got to be extra careful with our entry point, have a clear exit strategy ready to go.
Now, the book mentioned trading during a blow-off phase, but warned it's the trickiest, maybe even dangerous.
Yeah, it's like trying to, surf a tsunami. You might get a thrilling ride, but that wipeout could be bad.
The book suggested avoiding buying options outright during a blow-off, sticking to credit spreads or risk reversals, with wider strikes because of the volatility.
Right, and it really stressed that 2-time frame analysis to spot those potential reversals so we can lock in profits or cut losses fast.
So no matter what Apple's doing, range-bound, trending, or going crazy in a blow-off, we've got strategies to match.
And these ideas, they apply to any stock we're looking at, not just Apple. Each one will have its own personality, its own volatility, its own connection to the market. We need to consider all of that.
It's like having a toolbox. You've got different tools for different jobs.
And the more we practice, the more we observe, the better we get at picking the right tool for the job.
Speaking of tools, let's talk about managing our equity. That was a big point in the book.
Absolutely. Picking the right strategy is just one part of the equation. We got to manage our risk, right? Can't blow up our account, even if we're winning more trades than we lose.
Right. The book warned about that risk of ruin, even with a winning strategy. One bad trade, especially if we're over-leveraged, that can wipe out all our hard work.
Exactly. That's why the book says never risk more than 3-4% of our capital on any single trade.
Okay.
This helps us handle those losing streaks that are bound to happen. Stay in the game for the long run.
It's about the long game, not about gambling it all on one roll of the dice.
Right. And it's key to understand how win rate and variance play together. A high win rate doesn't mean much if our account balance is all over the place. We need consistency.
So we need a strategy that gives us more winners than losers, but with losses we can handle that won't derail our progress.
Exactly. That's where backtesting comes in. Trying things out on historical data to see what fits our style, our risk tolerance, gives us a realistic idea of how a strategy might actually work in the market.
The book also talked about position sizing, using a percentage of our account balance instead of a fixed dollar amount.
Right. That way, our positions grow as our account grows. We can scale up as we get more experience and confidence.
Makes sense. And we need to adjust those sizes depending on how volatile the stock is.
Absolutely.
Yeah.
A wild stock, like, say, Tesla, would need a smaller position size compared to something calmer, like Coca-Cola, even if our account could handle bigger trades.
It's about matching our risk to each stock, not just throwing money at every opportunity.
Precisely. And that brings us back to that constant observation and analysis, understanding what the market's telling us, recognizing those patterns, and adapting our approach.
I'm starting to see how all this comes together. We're not just randomly buying and selling options, we're managing risk, being systematic, constantly learning and improving our methods.
That's the key takeaway.
Yeah.
Weekly options trading can be really rewarding, but it takes discipline, a deep understanding of how markets work, and always being willing to learn and adapt.
So where do we go from here? How do we take all this and actually use it in real trading?
That's a great question, and the perfect way to start the final part of our deep dive.
All right, so we've got the map, right? We've got the tools. But like you said, the real journey starts when we actually, get out there and trade.
It does. And remember, there's no magic formula, no one-size-fits-all approach to this. It's about finding what works for you, your risk tolerance, what you want to achieve, your own trading style.
Yeah, the book definitely gave us like a solid foundation, a way to approach this market, feel more confident. But I think what really stuck with me was how much it emphasized that psychology of trading.
Oh, it's crucial. It's the basis for everything we do in the market. If we let our emotions take over, well, we're no better off than those folks caught in the South Sea bubble or any of those other crazy speculative manias throughout history.
It's like that saying, history doesn't repeat, but it rhymes.
It does.
We might have fancy trading platforms now, algorithms, all that, but human nature, that stays the same.
Fear and greed, those are powerful forces. They can really cloud our judgment, lead to those impulsive moves, those costly errors.
And that's why I like how the book focuses on the technical side. Base our decisions on what the price is doing, not on the latest news or rumors.
Staying disciplined, that's key.
Yeah.
Sticking to the plan even when things get rough. And trust me, they will get rough.
The market loves to mess with us.
Oh, yeah.
It's designed to test us, to shake us out of our positions at the worst possible moment.
It's that constant battle between our rational mind and those emotional urges.
Yeah.
And the better we understand those urges, the better we can control them.
So it's about being self-aware, knowing our strengths and weaknesses as traders, and then coming up with ways to work around those weaknesses, right?
Exactly. If you know you tend to chase losses, for example, set a hard stop loss, that'll prevent you from going deeper down the rabbit hole.
Right.
Or if you get greedy, holding on to winners for too long, set a profit target. Lock in those gains before they vanish.
Like having guardrails, right?
Yeah.
On a winding road. Might not stop every accident, but they'll keep you from going off the cliff.
Perfect analogy. And don't forget, the learning never ends in this game. The market's always changing. We got to keep up.
So it's about staying curious, always reading, going to those seminars, back-testing new strategies, always looking for an edge.
Even the pros make mistakes. It's part of the game. It's how we learn from those mistakes that makes the difference.
So it's not about being perfect. It's about being, resilient, adapting, and constantly tweaking our approach.
Exactly. Every trade, it's a chance to gather information, analyze how we did, and get a little bit better. Embrace the whole process, the highs and lows, the wins and losses. Each one helps us grow as traders.
That's a great mindset to have. Now, this book was all about weekly options, but it feels like a lot of these ideas apply to, trading in general.
Oh, absolutely. Whether it's stocks, futures, Forex, whatever, understanding market psychology, managing your risk, having that disciplined approach, those are essential for success.
It's about building that solid trading mindset based on logic, discipline, and constantly seeking new knowledge.
Couldn't have said it better myself. This deep dive, it's given you a roadmap, the tools, the techniques to navigate the world of options. But in the end, it's your journey, your capital, your risk, your goals.
So get out there, explore, try things out, and never stop learning.
And most importantly, have fun. Trading should be challenging, yeah, but it should also be enjoyable.
Thanks for joining us on The Deep Dive. We'll see you next time.